Alasdair Macleod. Alasdair, thank you so much for joining us today.
That's my pleasure.
All right. Now, the first topic I'd like to discuss is China's economy, because you've recently written about how there are severe threats to China's economy, largely coming from what you have titled, the next credit crisis, and you think that'll severely harm China's economy. Can you expand on this?
Yes. My supposition, and I think there is some evidence that this is right, is that we are currently heading into the next credit crisis. The point about a credit crisis is that it occurs after interest rates have risen, and they have generally risen because inflation pressures are mounting. And to some extent, this is now being anticipated by the Fed, which is raising interest rates ahead of official inflation pressures rising. And there comes a point where the business models of manufacturers gets undermined, and they find that you have, the sort of, if you like, the cost of working capital is more than they thought. You find that the cost of inputs, raw materials, the machines they have to buy to make things, labor and all the rest of it, start rising. And suddenly the assumptions under which they set off on making something no longer apply. So what do? They put the thing on hold, or do they just struggle on for a bit? Usually they will struggle on for a bit, and then there comes a point where it just becomes completely untenable, and then they start cutting back, laying people off. The bankers then start seeing this and start worrying about their exposure, their loan exposure to industry, and so on and so forth. And it's that creates the crash, if you like. It's never a recession in the sort of gentle sense nowadays, because the amount of interference in the economy at the earlier stages of the credit cycle is very, very significant. I mean, we've seen this with zero rates. We've seen this with the Fed rushing out and buying assets to support the banks, and assets paying considerably over value for assets to take them off the bank's hands. Now, all that was a long time ago, admittedly, but it's begun to work through, and we have a situation now where we are coming to the end of the cycle. And once the cycle comes to an end, you then have the crisis. Now, the reason this matters as far as China is concerned is that the crisis is a dollar crisis, and it's a global crisis. And this means that China's manufacturing economy, and it is overwhelmingly a manufacturing economy, gets hit, if you like, probably worse than any other economy by the crisis. And consequently, the Chinese have to think about how do they avoid this crisis. Taking back a step or so, the Chinese, in analyzing the Fed's monetary policy, and indeed the way in which the monetary policy is controlled with the dollar and whipsawing the dollar in foreign hands and all the rest of it, the way they see it is that, first of all, the Americans lower the interest rates. They allow the creation of businesses and wealth in foreign countries. And then when the time is right, they raise the rates, and in the Chinese strategist's words, to harvest the economy. And basically what happens is it breaks an economy, and in this case, China would think that she is being targeted. And afterwards, once the economy is broken, American industry will be able to walk in and pick up the bits and pieces she wants. That is the suspicion that the Chinese have. I'm not saying whether it's right or wrong, but that's what they think. Consequently, they have to avoid being harvested by the American government. So from their point of view, they need to come to some sort of economic arrangement whereby the rise in interest rates in America and the dollar do not apply in China. And the only way they can achieve that is to link the yuan to gold so that the yuan adopts gold's interest rates rather than, let's say, the dollar interest rates plus a margin an extra margin for the risk of yuan over the dollar, which means that the interest rates in China would have to be considerably higher. So that was my proposition, that it's going to make sense for the Chinese to monetize gold. The other side of it is that they're one of the few governments that can actually do this because they don't have the burden of a welfare state. In other words, the government's own borrowings are very much under control. They don't really need to raise money. Another country like America, if they were to try and achieve this with 8,132 tons of gold, would simply fail because politically she can't make the cuts in public spending necessary for the government to stop having to borrow. And so China is actually in a very good position to do this if she has got the gumption to do it. And that is obviously the big if, and we don't know.
Definitely. And what would this look like if China actually monetized gold? How would that really work?
Well, what I've proposed is that she creates or issues a perpetual bond. And the example I've used is a 1 trillion yuan bond, which works out at about $130 billion. The coupon on that bond would be payable in gold or in yuan at the holder's choice. Now, obviously, they would need to fix a rate. So the way in which this would work is China would announce what her true gold reserves are. She would announce her intention to issue a 1 trillion perpetual loan bond at whatever yield, and she would fix the gold yuan rate after a period of time once the market is adjusted to this news. What would happen, obviously, is the price of gold would rise quite significantly. Now, if it didn't rise to the level that the Chinese wanted to see, and they would probably have an idea what that is in their own minds, then they have got massive quantities of US treasuries to sell to buy gold. And this, incidentally, would make it impossible for the Americans to intervene in this process. So I think that China can grab the initiative on this. She can set the rate. She's got the mechanism. She can put together the mechanism, which I've actually based on the old British consolidated loan stocks, which we used to call consols, which were first issued in 1751. And believe it or not, the last consols was redeemed in 2015. So that particular gilt had the longest history of any bond ever seen. And there are advantages to this because it's also a mechanism. If you think about it, by going on the gold standard, the Chinese public have got something like 17,000 tons of gold. That's what's been delivered out of the Shanghai Gold Exchange. It would add roughly $500 billion worth of value to those gold holdings if, let us say, the price of gold on the announcement rose towards the fixed level of, say, $2,000 to $2,200. That means that there would be an enormous injection of wealth into the Chinese economy in ordinary people's hands, and it would be widely spread as well. And as well as that, the bond would be able to be subscribed by Chinese residents, Chinese nationals, and foreigners. And anyone who buys the bond, and I suggested it would be issued at a discount, as the situation becomes more accepted, you would find that the yield would tend to fall, which means the bond price tends to rise, and that again would create wealth amongst the Chinese public. Exchange controls would have to be dropped. That's the other thing. It would produce problems perhaps for some of the exporting businesses, but exporting businesses in China are not there so much now to take advantage of the cheap situation of cheap labor and all the rest of it. Those have tended to move off to places like Vietnam and Cambodia and other areas in Southeast Asia where there is lots of employable labor, people who are cheaper to hire than the sort of, let's say, the semi-skilled and skilled Chinese factory operators. So I think that the business of China has evolved enough, if you like, to move into a hard currency regime rather than relying on the soft currency regime, which undoubtedly was used by China to encourage the establishment of international businesses in China going back from the 1980s onwards.
Now, how would this impact the dollar? It seems like if it would probably, as you're saying, really increase the gold price, and that would probably not be good for the dollar, would it?
No, it wouldn't. It would kill the dollar. It would hit the dollar very hard. But the problem is that China is, so far, what China has done is try not to upset the international boat. I mean, she's clearly stated her intention that she wants to do her business settled in yuan, but she has never, ever suggested that she wants the yuan to be a reserve currency to challenge the dollar. She's never suggested that. She's always taken this very, very sort of quiet route of gradually doing her business, extending her interests, doing it commercially, and not really upsetting anyone. Now, there comes a point where you can't do that anymore. And what I'm suggesting is that that break point is the coming credit crisis. Because unless China does this, and instead is faced by far higher interest rates, is the damage to the economy, I think, could destabilize the state. Remember that there are over 40 different ethnic groups in China as a whole. And the only reason they're not at each other's throats basically is because you've got a strong centralist government that doesn't allow democracy in Western terms. Any dissent is jumped on very, very smartly. That is the way China has her cohesion. That's how she exists. And I think that if she had a really bad slump, I think that cohesion would start coming apart very badly. That is the risk China faces by not embracing sound money.
Very, very interesting. So, yeah, I mean, can you get into that a bit more? Because I mean, how speculative is that? Is there really any indication right now that that is the path they're going to, besides that, it looks like there's a credit crisis coming? Is there any indication from the government that gives you the idea that they're heading towards sound money?
I think they've always been heading towards sound money simply because back in 1983, the People's Bank of China was appointed with the task of acquiring the gold and silver on behalf of the state. And if you look at the capital flows and take roughly 10% of what those capital flows were from 1983 to 2002, I come up with an investment in gold bullion at contemporary prices. And remember, there was a huge, great bear market which made the stock available at a time when there was a massive increase in the rate of mine output. I think it's quite possible that she accumulated up to 20,000 tons. In that article, I say 15,000 to 20,000. That's more than enough for her to do what I suggest. She's also done other things which shows quite clearly she thinks that gold is the future. She is now the largest gold miner in the world, producing over 400 tons per annum. This is way ahead of anyone else. The state has retained the monopoly on gold and silver refining. And she also buys in doré from abroad and refines that. She doesn't allow any gold to leave China. It's a one-way trip. It goes in from outside, but it doesn't leave. So tell California for gold, if you like. And not only that, but she has made sure that she controls the physical bullion markets around the world. I mean, the Shanghai market is now the biggest physical delivery market. On top of that, she has alliances with other markets. And through Hong Kong, of course, there are Chinese interests own and control the LME, the London Metal Exchange, which earlier this year set up precious metals contracts for the first time. So you can see that one way or the other, she's made moves to control the gold market, bring it under her control. And I cannot see how she would have done this unless she believed in the long term gold would be the future form of money, or defined as yuan or whatever, in China. And also bear in mind that the sort of Marxist universities, both in the old Soviet Union and China, taught one thing, and that was that the capitalism would collapse, and obviously if capitalism collapses, then the currencies go with it. So even though China has adopted a lot of the capitalist methods, she knows she should know how to escape from it. Now, against that, obviously, over the decades, the Chinese, now I think as much as middle-aged bureaucrats, have been educated in Western universities and have taken on Western economic theories, particularly the sort of neo-Keynesian theories. She's also embraced very much the expansion of bank credit as a means of financing her underlying economy, admittedly mainly through state banks. So what we don't know is to what extent the original view that led her to start accumulating gold has actually been corrupted. But I would suggest that she sees huge strategic value in controlling the gold market. And that can be played out either one of two ways. If America cooperates, then she backs off from monetizing gold through the yuan. If, on the other hand, she ends up with difficulties with her relationship with America, she's always got what amounts to a nuclear option, and that is to introduce a gold standard for the yuan. It would undermine the dollar, of that there is no doubt at all. I think what's happened recently is that rather than the geopolitical tensions being fought under the umbrella of a gold nuclear option, we're now in the situation where unless China embraces gold as part of her monetary system, then she is going to end up, I think, with an enormous slump. And as I said earlier, I think that could actually threaten the cohesion of the state.
Now, you talked about the credit cycle, the next credit crisis really being a threat to China. What about this trade war? Does this have anything to do with it?
The trade war is, I don't think it has directly. What we don't know is whether there's, in the background to this, there's some sort of, if you like, sort of fight between the intelligence services and, on a strategic basis, that the trade wars are part of putting pressure on China for other reasons. I don't really see that. I just think that what you've got a president in President Trump who believes that China is ripping off America and wants to put a stop to it. And you've got other forces in the government that realize that actually the reason there's a trade deficit is not so much because it's China, it's because of the monetary policies of the fiscal policies of the United States, monetary and fiscal policies leading to the expansion of credit. And it's that inevitably creates a trade deficit. And if you stop if you stop importing from China, then you've got sort of a domestic problem, and that is that you push up inflation domestically because there's too much demand to be contained within the U.S. economy without some of it being siphoned off into imports.
So you talked about how China adopting gold into their monetary system could impact the U.S. dollar. How would it impact things in the United States economically?
I think I'd look at that a slightly different way. America has an inflation problem. The only people who won't admit it are the BEA, the Government Bureau of Economic Affairs. They have produced a CPI, as indeed all other countries have, which understates the rate of inflation. And the reason it understates, or the way in which it understates it, is that it changes the basket so that things which are more expensive are replaced by things that are cheaper. There's also hedonics introduced in certain categories of consumer demand. But actually, if you look at a fixed basket, a basket that doesn't change at all, such as put together by the Chapwood Index, then the rate of inflation is closer to 10%. And was last year, and the year before that, and the year before that. In other words, the purchasing power of the dollar is sinking a lot more rapidly than official statistics admit. Now, let us assume that interest rates are rising, and they will continue to rise. Now, if they continue to rise, there's going to come a point, I think, where the government's arithmetic in terms of its funding costs are going to start looking very, very wrong. And at that stage, you're going to get people beginning to ask questions. You've got, the American government getting into a debt trap. Not the only one, incidentally. We're all in the same boat. But once that government has got into a debt trap with higher interest rates, say, having to pay, 4%, even 5% on its treasury bonds, new treasury bond issues, then at that stage we then start asking questions like, do we really believe the rate of inflation? Is it actually understating the whole situation? And you can see that once the doubts start creeping in, we're then moving into a completely different inflationary environment. I mean inflationary in the sense of market understanding of what inflation is and how that impacts on bond yields. As soon as people realize that the purchasing power of the dollar is sinking considerably more quickly than official figures suggest, then at that stage, I think you'll find that not only do we have rising interest rates, but the era of low interest rates is over. The implications of that are extremely serious because the debt traps will be sprung not only on the US government, but also all the other governments with wealth, which are welfare states, the European Union governments in the Eurozone, Britain, also Japan, and China risks getting stuck in this. And this is why I think that China has got to exercise its option. And none of us have this option, incidentally, to introduce gold to stabilize interest rates domestically. We can't do it. And I think that China, by moving the yuan, giving the yuan gold backing, yes, that really would accelerate the dollar's problems and indeed the problems of all the paper currencies which are tied to it.
All right. Well, very interesting times, Alasdair. We'll have to, keep tracking this as all this plays out, and we'll see if China actually does take that option of monetizing gold.